are presenting the evidence tree, and our topic is about auditing. The team members are González Páez, Diego Alfonso, Montejo Ruiz, Sergio Manuel, Morales Juárez, Estrella Saraí, Narváez Hernández, Dana Paola, Enay, Taraco Carlos, Dorel Saraí. Introduction. In this topic of our content review, we will see its concept, what is for unclear and precise way, like why. We will talk about the topics and objects, which is the utmost important to know for us who are students accounting. Meaning and definition of auditing. Accounting and auditing have a pivotal role to play in the financial record-keeping process of any business, though their roles are different in their focus. Auditing is a part of the accounting world. It's an examination of accounting and financial records that's undertaken independently. This is done to determine if the company or the business undertaking has conformed its operation to the laws and the generally accepted accounting principles. It's an examination of accounting and to ascertain whether the financial statement gives true and fair view financial position and profit or loss of the money. Auditing is the intelligent to critical test of accuracy, and dependability of accounting data in accounting statements. What is the importance of auditing? Accounting is a file is vast and comprises many areas of specialization within its frameworks. Auditing is one of such specializations. The importance of auditing is particularly seen in case of errors in your accounts. If your bookkeeping has not been up to date or in order, an auditor can make significant contributions in uncovering these details. If the details uncovered don't need any presence of fraud or wrongdoing, a forensic auditor service is advisable. There is a further subfile even in the realm of those deals that deals with cash burning on the lines of criminal activities.
Hi, my name is Sergio and I talk two types of audits. There are different types of audits that can be applied depending of the need of the organization. Financial audit determine whether an organization financial statement accurately represent the result of the business financial operations. It makes sure that the operations financial position is in accordance with the generally accepted accounting principles. Compliance audits check in the company has function is accorded with the laws and regulations that may materially impact the financial statement. Internal audit. Internal audit take place within your business. At the business or you initiative to audit what someone else in your business conduct is. Businesses that have shareholders or board members may use internal audit as a way to update them on their business finances. And internal audits are a good way to check in a financial goals. Then external audit. An external audit is conducted by a third party such an account, the IRS or a tax agency. The external auditor has on connection to your business. An external auditor must follow generally accepted auditing standards. Like internal audit, the main objective of an external audit is to determine the accuracy of accounting records. Investors and lenders typically require external audits to ensure the business financial information and data is accurate and fair. Audit reports. When your business is audited, external auditors usually give you an auditor report. Audit reports include details of the audit process and what was found, and then report includes whether your financial records are accurate, missing information, or inaccurate.
Good morning, my name is Estrella and I will continue with the following types. 3. IRS tax audit. IRS tax audits are used to assess the accuracy of your company filed tax returns. Auditors look for discrepancies in your business' tax liabilities to make sure your company did not overpay or underpay taxes. And tax auditor review possible errors in your small business tax return. Auditors usually conduct IRS audits randomly. IRS audits can be conducted via email or through in-person interviews. 4. Financial audit. A financial audit is one of the most common types of audit. Most types of financial audits are external. During a financial audit, the auditor analyzes the fairness and accuracy of a business financial statement. Auditor reviews transaction procedures and balances to conduct an financial audit. After the audit, the third party usually releases an audit opinion about your business to lenders, creditors, and investors. 5. Operational audit. Operational audits are similar to internal audits. An operational audit analyzes your company goals, financing process, producers, and operation results. Generally, operational audits are conducted internally. However, an operational audit can be external. The goal of an operational audit is to fully evaluate your business operation and determine ways to improve them.
Compliance audit. A compliance audit examines your business policies and procedures to see if they comply with internal or external standards. Compliance audits can help determine whether or not your business is compliant with paying works, compensations, or shareholders distributions, and they can help determine if your business is compliant with IRS regulations. Information Systems Audit. Information Systems Audit mostly impact the software and IT companies. Business owners use an information systems audit to detect issues relating to software development, data processing, and computer systems. This type of audit ensures the systems provides accurate information to users and makes sure monitors side parties do not have access to private data. Also, IT and non-software business should regularly conduct mini cybersecurity audits to ensure their systems are secure from fraud and hackers. Payroll audit. A payroll audit examines your business payroll process to ensure they are accurate. When conducting payroll audits, look at the different payroll factors such as pay rates, wage tax, withholdings, and employee informations. Payroll audits are typically internal. Conducting internal payroll audits helps prevent possible external audits in the future. Business should conduct internal payroll audits annually to check for errors in the payroll process and remain compliant. Pay audit. Pay audits allow you to identify pay discrepancies among your employees. A pay audit can help you spot unequal pay at your company. During a pay audit, analyze things like disparities due to race, religion, age, and gender. Pay audits can also help you ensure workers are paid based on your business industry and locations.
Bueno, mi nombre es Diego y en esta ocasión les voy a hablar sobre los Objectives of Auditing. The objects of auditing are changing weight, the advancement of business techniques. Here I was only to check the corrections of recaps and payments. The objects of the auditing have been classified under two heads. 1. Main object. 2. Subordinating objects. Main objects. The main object of the audit is to find reliability of financial position and profit and loss statements. The object is to ensure that in the accounts reveal a true and fair view of the business and its transactions. The object is to verify and establish that at given date balance sheet present true and fair view of financial position. Subordinating objects. Detection and prevention of fraud. The one of the important subordinating objectives of auditing is the detection and prevention of fraud. Fraud refers to international misrepresentation of financial information found might involve I. Manipulation, falsification, or alteration of records or documents. Misappropriation of assets. Suppression of effect of tracing from records or documents. Because of tracing white substance. Misapplication of accounts policy. 2. Detection and prevention of errors is another important object of auditing. Ensure that there is on my statement in the financial statement. Comparison table of advantage and disadvantage of auditing. Advantage. Ensure compilation. Auditing helps while business or system improvements. Quickly credibility. Prevent trend. User for planning and boot hating. Disadvantage. Auditing is costly. Auditing requires experts. Impossible to check two transactions. Unlike for small business. Risk of bias and threats.